Now we want to go into a discussion where we are going to go through recovering credit losses. We know that definitely so much has been able to change over time, especially after this post-pandemic period. We know that there are heavy losses that were there. We know that the banking sector definitely goes through some rigorous process when it comes to the loan applications, from the credit administration to the credit analysis team, and finally now it comes out. But I know there's quite a process there. But we want to see how financial institutions can be able to recover from there. And we have an amazing panel from the BFSI sector that can be able to guide us when it comes to recovering credit losses. And to moderate this session for us, this is none other than the MD for Tala East Africa, Ivan Mboa. All right, welcome, and over to you, Ivan.
All right, good morning, everyone. Absolute pleasure to be here. Hope you can hear me clearly.
All right, thank you so much, Ivan. Where are we reaching you from? Are you in Kenya? Are you within the region?
No, dialing in from Accra, Ghana.
Fantastic.
In West Africa. Yeah,
fantastic.
Pleasure to be here with you all. Great, and I'd like to maybe start off by asking my esteemed panel to introduce themselves. This morning we have Kevin Mutiso, we have Catherine Moraga, and Lanre Bamisebi. If you'd like to go ahead and introduce yourselves, that'd be great. Maybe starting with Catherine.
Thanks, Ivan. Good afternoon, good day. I hear it's still morning where you are. Glad to be here. My name is Catherine Moraga. I head engineering at Stanbic Bank. Engineering comprises of data analytics, technology and operations, cybersecurity, bank projects. And at Stanbic Bank Kenya, we are a franchise of Standard Bank Group based in South Africa. And in Stanbic Bank Kenya, we say Kenya is our home, we drive our growth.
Thank you. Kevin Mutiso.
Good afternoon and good morning to everyone. Thank you very much. I wear two hats. Firstly, an entrepreneur. I'm the CEO of a company called Oye Platform Solutions. And what we've done is built an ecosystem of boda riders by building digital fast financial services for them. And we've started with a insurance product and then moving on to a lending product. The other hat I wear is I am the chairman of the Digital Lenders, where Ivan is my co-director. And we lobby on behalf of the digital lending ecosystem for progressive and fair regulation. Thanks.
And last but not least, Mr. Lanre.
Hi, thank you very much, and thanks again for inviting me to the panel. My name is Lanre Bamisebi. I sit as the group manager director for FinCell Africa, and I'm also the head of IT and operations for Equity Group. So I'm happy to be on this panel, and I'm open to the discussion. Thank you very much.
Great, and my name is Ivan Mboa. Actually, just a slight change of status. I was most recently the East Africa Managing Director at Tala, and I've since actually migrated to West Africa, where I'm setting up a new fintech on behalf of a bank, Ghana. But that being said, I'd like to perhaps start off this afternoon's conversation with a little bit of background and context setting. COVID-19 has been described as having accelerated the world into a digital-first future. Here in Kenya, we saw banks accelerate the closure of some physical branches and nudge their customer base towards 100% adoption of digital channels. Some businesses were unable to accelerate into this digital-first future and suffered lower revenues, full-year losses, and staff layoffs in 2020 and going to 2021. The Central Bank of Kenya preemptively asked banks to provide defaulters with a deferral of listing at the credit reference bureaus. And some banks also went ahead and preemptively worked with the same customers to restructure existing loan facilities to avoid a sharp rise in non-performing loans as COVID essentially stepped into place. And so as we begin to imagine a post-COVID world, there are aspects of how the world in Kenya work that will not return to pre-COVID norms. So today, I'd like to ask our panelists who represent senior technology leadership across the leading banks in fintech to give us a sense of COVID, the resulting credit losses, and technology's role in addressing the same. So first question to all panelists I'd like to start with, Catherine, is could you please provide the audience with your summary assessment of the impact of COVID on your bank's lending business? Is your institution, as of today, on the other side of this crisis?
Thanks, Ivan. And you rightfully put it, the pandemic impacted everyone. And if you look at it from a financial services perspective, specifically banks, when you look at the results that were received and published, you could see the performing loan perspective. But bringing it closer home from a Stanbic Bank perspective, what are the key things that we quickly had to do? So all this is anchored around agility in terms of the things that we had to pivot and working very closely with our customers. As you rightfully put it, we were the first bank in this region to support our clients with restructures of loans. We did restructure around 31 billion worth of loans. But also from an agility perspective, we had to reassess our ways of doing business. COVID did present a case where it was low touch from a customer engagement and also staff engagement. One of the things that we had to quickly pivot is through the projects team, use technology, redefine our processes, automate things like customer acquisition. So, and with that, we saw an acquisition of what used to be 100, say, as an example, 100 customers a day, going to 400 in a day, and doing away with forms. A late entrant in the digital lending space, but we did also manage to pivot into digital lending to existing customers and grow our loan book from a digital perspective to around 5 billion. And it goes back to pivoting and using technology in agility in decision making. And these are things that now are here to stay and forcing us to rethink how we do business. If you look at it from pre-COVID and now, quote unquote, still with COVID, but not as large as it was a year and a half ago. Another area is things to do with debt recovery. Fully appreciating that, what else can we do from a technology perspective? So implementing things like, we call it the sniffer capability. How do we sniff? For example, Ivan has money in his current account so as to promote the recovery team objectives, as an example. And lastly, deploying things like robotics process automation to support staff, give them meaningful work, especially from a perspective of teams that process large transactions that are of a manual nature and are repetitive. So for us, Ivan, those are some of the things that we embraced and will continue enhancing even as we continue in this new world.
Okay, great. Thank you, Catherine. You almost jumped ahead to my next question. I was going to ask later on, but I appreciate that. So Kevin, maybe you could help us understand what's your assessment of the impact of COVID on your lending business as a fintech? Would you say that your institution and institutions that you represent, SPLAC, are on the other side of this crisis?
So I represent two institutions, one that was negatively affected due to the sudden shock, as we were purely lending business with no deposit taking side. And the key lessons there was, one, using data to better identify good customers and sort of trusting the process along the way. We learned a lot about our customers, and that's actually how we pivoted into the Boda ecosystem by asking ourselves the question, do we want to be a vanilla product? Do we want to, sort of lend to everyone, or do we want to find a niche that we can become the best at? And serve that customer base very well without sort of thinking about anyone else and sort of designing specifically for them. So I'd say, yes, we've come out on the other side, head above water. It has been an interesting journey in terms of key lessons learned. And then on the regulatory space, I think on that front, we've also done quite a decent job where engaging with the regulator has gotten us to the point where we now have regulations that will come into place in September. We expect that this will bring in more investment into the sector and sort of build that, that fintech ecosystem in collaboration with the banks as well.
Okay, great. Appreciate that. Lanre, what are your thoughts on, the impact of COVID on equity banks lending business, both across FinServ and the traditional bank? Would you say equity is on the other side of the crisis?
All right, thank you very much. When COVID started, the first thing we did was, as a systemic bank, we realized that, our decision has impact on the
Is anyone else unable to hear Lanre?
I believe that Lanre is on mute. And it seems that
no, I think
he's coming
internet.
To all right, so Ivan, we can be able to just proceed with the next person.
Sure, as we wait. Yeah, sure, no worries.
Sort it out.
As we wait for Lanre to get back. Catherine, I kind of wanted to follow up from something that you mentioned, that you sort of touched on a little bit, which is sort of robotic process automation. Maybe for our audience, I'll sort of dive a little deeper. In an interview that you gave to Credit Info in 2020, you stated that in the future, as a consequence of COVID, there'll be a redefinition of business processes that may come with the increased adoption of robotics process automation. Can you do two things? How do you define robotic process automation in layman terms for the general audience? And then also, could you give us your thoughts on how Standard Bank could use robotic process automation in both credit underwriting and also in debt recovery? You touched a little bit on the debt recovery side, but maybe let's give us a general sense for those of us who are not so familiar with RPA. What is it, and how are you thinking of incorporating it post-COVID in how you underwrite customers and how you recover debt from customers that are past due?
Thanks, Ivan. How would I explain RPA to a layman?
Yes.
Software.
Yes.
A robot in the form of a software that is used to conduct repetitive tasks. So I'll give you an example. What is a repetitive task? Every day, bank, there's a team that does reconciliation to reconcile and say, 100 Catherines did M-Pesa transactions. So are there any exceptions? Is there a case, say, for example, you did an M-Pesa, you requested money from your bank account to M-Pesa, your M-Pesa wallet. Your account was actually debited, but your M-Pesa wallet was not credited. So how do you handle that reversal? And imagine as the bank, given the size of the institution, it multiplies the number of transactions that happen. So reconciliation officers are supposed to sit down with an Excel and every day follow very similar strokes or instructions. List this column, perform like a search or what we call VLOOKUP, and then say, actually, Catherine is out of pocket. We need to send this money to her M-Pesa wallet. So RPA, a software robot that can mimic repetitive tasks or strokes that we conduct on a machine, and therefore giving that staff meaningful work. Because at times you find reconciliation staff or any staff that conduct repetitive work, it's mundane, it's boring. And the beauty about bringing in a robot, the robot will work 24/7, and also it has extra time to take on more work. So that's how I'd explain RPA to a layman. With regards to your question, in terms of use cases, the one use case, actually two use cases that I've seen work very well or I've had the experience. First of all, I talked about reconciliation. We've seen a case where reconciliation would take close to 3 hours, but courtesy to using RPA, it is done in 15-30 minutes. So it frees the staff. Yeah, amazing. the staff is left to only handle exceptions. Therefore, it gives the staff meaningful work. And also, here is Ivan, a degree holder, has been conducting reconciliation for years. We now tap into what else can Ivan do in terms of giving them meaningful work. How do we stretch your brains? That's what I mean by meaningful work. So we've used RPA in reconciliations from payment of, or reconciling transactions from, say, Kenya Revenue Authority, PesaLink, such things, and also extending it to debt recovery, the repetitive tasks. It cannot do everything. For more advanced repetitive work, now that's when we explore other technologies. But for repetitive tasks that can just be mimicked by, again, RPA, it does the job very well.
All right, it's really interesting. I mean, it's fantastic. Like taking reconciliation down from 3 hours to 15, 30 minutes. Yeah, this is pretty amazing. Maybe I'll now jump to Kevin. You know, you touched on this a little bit in your response, but I wanted to kind of ask, what is the most important lesson or takeaway that you have learned as a CEO, as a leader from COVID-19, especially in fintech, to help you navigate the next economic shock that may cause a spike in defaults and difficult bad debt recovery? So if you're thinking to yourself, if COVID is the dress rehearsal for maybe one massive shock in the future, and it could be anything from political election violence, it could be the next global pandemic, you name it, but a repeat of 2020, what wisdom are you going to carry with you from 2020 into that future? Specifically on, I would say managing defaults and improving bad debt recovery.
So I think the number one piece of wisdom is continuous engagement with the regulatory framework. I think for us who are in the space, an announcement by a leader could change the behavior of the customer of almost overnight. And so creating those channels between the regulator and the business and private sector, one of the key pieces of wisdom or lessons learned, because what you want is some stakeholder engagement before those kinds of decisions are made, then two announced, because without that engagement, they don't know what the potential impacts could be, not just to us, the business, but even to the market. Because if you remember initially in 2020, particularly in digital lending, the first shock was we had significant defaults, but then because of that, we held back lending. And you would have found that lending could have been could have saved, a margin, a significant proportion of businesses that would have done well with the access to finance we were giving. So that's the first lesson. That I think every CEO in fintech should sort of have. The second is because we had, and this is particularly to us and me as Kevin and our business, we had a pretty vanilla product where we didn't focus on the needs of one demographic. We hadn't really built that customer loyalty or that customer partnership or mind share within the customer's mind. Therefore, we were one of the first people they would like to default on, right? So before they default to Tala, they'd rather default on Shika. And that was just because we did not have the mind share, we did not have the relationship, we did not have that sort of in-depth understanding of that customer's needs. And it was simply because we hadn't put focus on one demographic. I think what that does is that it defends the balance sheet, because the customer knows the additional benefits by maintaining this line of credit in a healthy way. They will always ensure that they're paying back on time. because of all the other additional benefits. And even if your portfolio is smaller in sort of the short and medium term, what tends to happen is that you can then also have larger average loan sizes over time. Because you understand this customer better, you're able to build better understanding of what and where to lend to them within their sort of process. And so that, I think that's the second major lesson I've learned. I mean, as you can imagine, it's been quite exciting, sort of gaining those insights on our new customer base.
Thank you, Kevin. Welcome back, Landry. Hope you can hear us. Why don't I give you back the mic, and I'll ask you two questions. But the first question is what you had started on before. We're kind of talking about FinServ equity, effectively the impact of COVID. Are you on the other side? And I think you left us at equity being a systemic bank. You were about to make certain decisions, and I think that's where you cut off. So do you want to maybe pick up from there?
All right, thank you very much. Apologies for the interruption. Yes, like I was saying, we are a systemic bank, and because of that, when you're systemic, the decision that you make during a pandemic like COVID actually does impact the whole economy. So what we did was we supported the economy. We gave our customers the reprieve to be able to do their loan, do some management and repayment and restructure of their loan. So we closely managed to give out a loan about 171 billion loans, and during COVID, we actually restructured most of these loans. And since the economy has resumed, about 122 billion of those loans have been coming back. So we didn't really feel the impact much. And what we did was to immediately launch what we call Joari, which is a credit scoring solution. What this does is help us to fine-tune the way we give credit out. And we launched it about 4 months ago, and we've had about 107 million credit. We've disbursed 107 million. And out of that, we've only had an NPL of 0.7%, which is very commendable. And then during COVID, it was almost like we were waiting for it as an organization, because we had already digitized most of our platforms. 98% of our transactions were already online. So it didn't come as a shock to us in equity. And if you look at our balance sheet during the COVID period, I think we grew about 40%. So what it did for us was to help us to accelerate adoption of some of the technology that we've been, piling on and wanting customers to adopt. We had less people coming to the branch, so most of them were going on the digital platform. And that grew it by about 98%, which means about just 2% were using brick and mortar. And since we were already prepared for it, it was easy for us to accommodate those customers and be able to grow our customer base. Thank you. You were going to shoot on the second question?
Sure, yeah. So, I think your group CEO, James Mwangi, has sort of famously publicly declared his intention to transform equity into a technology company with a banking license instead of a bank with a technology department. And some people believe that he may be racing ahead of his client base, who are still rooted in the offline world. And of course, you just quoted some really interesting statistics about the fact that 90% of your transactions are online. But let's also think about beyond just transaction processing, right? Or even origination requests. How does FD Bank intend to use technology tools to mitigate, offline cases of default, right? So you might be able to disperse a loan to me, with fantastic underwriting software through all kinds of mobile channels. But what happens when I don't behave the way expecting to behave, and I'm very much rooted in the offline world? How are you thinking of using technology to address cases like that? Okay,
so thank you very much. The issue of repayment, it's something you can't really, put your hands on, because people don't repay for different reasons. Some of the reasons they can control, and some they cannot control. So your own as an organization is to be able to preempt them, right? And that's why you use a lot of data. Data is not just about, understanding data. You need to understand the quality of your data and when you get your data. So what we've been able to do as Equity Bank is we've connected with almost all the other institutions to be able to understand data, relationship between two parties, understand, we're able to mark you to the last percent, the possibility of you being able to repay. And then we're also working on, for example, we realized that a couple of our customers, the 2% that are not on digital, like I mentioned earlier, 98% of them are on digital banking. So we've been able to give them product like the USSD, the mobile app, chatbot, and the rest of that. And for those who are not on smartphone, we are also trying to work on doing things like giving them device loan, right? So we are doing that in Rwanda. We are going to start in Kenya. So we give them device loan and also accelerate their movement into the digital world. And also, what we do is our loan, this credit scoring that we built in-house, using machine learning, is so robust. Right now, its NPL is 0.7%, which is one of the best in class. And so we give loan only to people that we have assessed to be able to pay back the loan. And in instances where we want to go up country, for example, we are trying to use things like voice authentication, right? So that, we know who you are, we can do a voice authentication. So you can actually do a whole voice banking to do a loan, to make a loan request, and also we do a disbursement. So for us, I'm not sure we're really struggling with getting our loans back, because our NPL is really low at this moment. Thank you.
Thank you, Henry. Very interesting. Very, very interesting. I think equity is continuing to lead the charge. So I want to bring the call to a close by asking my panelists a final question. What is one prediction that you made in 2020 at the onset of COVID on what you thought its intended effect on your business would be that turned out to be wrong as of 2022? So it's an unusual question. We always typically ask people to predict the future. Let's talk about what happened the last time you predicted the future in COVID, when you turned out to be wrong. And I guess that is hopefully a positive note to end on, right? Effectively, perhaps things didn't go as bad or perhaps as good as you thought. So maybe starting with Catherine, why don't you start us off with your 2020 predictions gone wrong?
Thanks, Ivan. As a business, we really braced ourselves and just looking at different models in terms of how the loan will perform, given that we could evidently see sectors that were struggling, sectors of the economy that were struggling. And looking at the book and dissecting it, just looking at the exposure per sector. But what was pleasing to see, and especially as the country started opening up and some businesses pivoted to new business lines, so they were able to still make good their loan repayments. And others, I guess it goes back to the resilience of businesses. So what was pleasing to see is that we had these models that, in a sense, braced ourselves for NPLs to really hit the roof. It was pleasing to see how businesses rebound, stayed the course, and were able to, sustain their repayments. So that did come to pass, and it's a good result.
Fantastic. A very positive note. Kevin?
I think mine is similar to Catherine's in the sense that I was very wrong at my prediction of the incumbent business being taken over by a newer player in certain segments. I was certain that they would lose, they weren't agile enough, they would not be able to adapt to this new marketplace. But even in our own sector in fintech, I'm very, very pleasantly impressed by a lot of what the banks are doing. I know I met Catherine's team, doing amazing things. I met some of the other banks as well. And so I think what excites me now is I'm glad I'm wrong. I'm glad that the incumbents have proven themselves and that they're agile and they've allocated capital well. And I think that also gives me excitement in the types of products and types of partnerships we're going to see in the future with the banks and incumbents in general.
All right, interesting. Let me just allow me just to jump in. Ivan, apologies for that. Just probably we can be able to see how we can wind up and see if we can get a closing remark from our wonderful panel. So over to you, Ivan, so that we can be able to proceed from there. Thank you very much.
Great. So you'll be happy to know these are the closing remarks. This is the final question. So okay. I think when you have Mr. Lanre to help us close the session with what is one prediction you made in 2020 at the beginning of the COVID pandemic that turned out to be wrong. And then I think we can thank all the panelists right after.
All right, fantastic.
All right, thank you very much for giving me the honor to close. I think like Robert Kiyosaki said, the future is created by what you do today, right? So for us at Equity, it was almost like we saw it coming. We predicted that our customer would move to the digital channel, and that we thereby created that enabling environment for them, and they did move. We moved from about 80-something% to 98% in terms of digital transaction. We also predicted that some of our staff would enjoy working from home. And as we saw, we realized after the COVID, it's, people are coming back even with their shot. People don't want to come back to the office. So now we've been able to have over 250 developers that are outside of Kenya, working from different countries around the world, Russia, Indonesia, and the rest of them. If you had asked me this a year ago, I would have told you all my developers should be from East Africa, but now 90% of them are outside of the continent. So it's important. It's actually coming to fruition that despite all our expectations, some of these things are turning out to be, to our advantage. And just in closing, I just want to thank my co-panelists, Catherine, and the moderator. You've done a very good job. It's been a good session. I enjoyed myself, and I hope we have more time in the next panel. Thank you, and have a good week.
Great. Thank you all very much.